So tonight's session is, unfortunately, for some of you guys, going to be the foundations of trading. So we do have new traders that obviously joins these groups, calls, and these communities, but unfortunately, there is also beginner traders that has no idea what the market is about or what Forex is about. So I'm just going to do a breakthrough and obviously share a book that I wrote myself. Everything that you guys will see that I present is something that I've created myself. I've not added anything from another course. Everything is obviously done by myself. And then just before we start, just a reminder that everything that will be explained tonight is not financial advice, just my personal opinion. Like I said, I don't sell signals, I don't sell courses, I don't sell anything. It's just me sharing my value that I've learned in the past 10 years. So yeah, I hope you guys find some value to it. If there is any questions, once again, just tap in and just ask me. And then obviously tomorrow night, we will be going into the market, breaking down the charts, explaining exactly how I analyze, how I start my week. Everyone that's part of the free community, for example, you guys will see that obviously we expected the pullback, for example, on OGSD. But I don't always explain why we were looking for the pullback on OGSD. But what we will be doing tomorrow night is actually sharing the reasons for what I see in the market, and obviously why I see certain moves. So due to my ADHD, I'm just switching off my camera so I don't keep looking at myself the whole night. And yeah, let's get straight into it. So I'm going to go quite quickly through the basics. If you've been trading for 10 years, then yeah, we do get to a point where you're also tired of hearing the basics. But the key thing is everything you do in life, if you don't understand the foundation of what you do, you'll never make anything a success of it. So if you want to go into becoming an engineer, you also have the foundation. In university, you don't actually learn how to build a bridge or how to put up the petrol station. You actually learn the foundations of what it is to be an engineer. And then you get the practical, which is obviously going into the market and physically trading and physically making mistakes, learning lessons. And through that is obviously how you achieve success in not just Forex, but anything in life. So if you are not new, just bear with me. I'm not going to be reading a PDF or anything in that sense. Like I said, everything in here is my own wording. It's my own book that I wrote. So I'm just going to be basically breaking it down in my own perspectives of how I see things. So I know a lot of you guys also have been trading with different brokers, been trading synthetic indices, etc. So that's the main reason, obviously, for these calls as well. So first of all, just to break it down, what is Forex? So if you travel to different countries, you obviously have foreign exchange. That's obviously exchange of currencies. So they created a market based on that called the foreign exchange market. So the Forex market is the biggest market in the world, $6.3 trillion on a daily basis. That's how much money goes through the Forex market on a daily basis. So people that will tell you Forex is a scam, most probably has money in a bank, FNB, apps, or whatever it might be. Banks is the biggest contributor to the Forex market. So you thinking Forex is a scam, but you most probably have money in the bank and they are probably trading Forex with your money. So the banks is the biggest player within the Forex market. Behind that, you have your investment firms, your hedge funds, mostly located in New York and also located in Mayfair in London. So you as a retail trader, doesn't matter if you deposit $100 or $1 million, you do not have the ability to move the market. Okay. We can only try and figure out what is the bigger guys doing and see how we can duplicate what they are doing. Going through the course in phase 2, I'll also be breaking down how hedge funds trade, how banks trade, etc. So it's not a really specific thing of this is our bank trade, but obviously explaining how they use sell and buy limits in certain supply and demand areas to obviously execute their trades. So the Forex market runs 5 days a week, Monday to Friday. It's closed on weekends. And you can obviously trade different currencies, commodities, indices against one another. So currency trading for me is the better thing to do. Obviously, a lot of you guys like trading gold. When I started trading 10 years back, indices like NASDAQ, US30 wasn't available to trade. So I learned trading currencies, and that's why till today I only focus on currencies. They do move slower, and that's also a narrative that's getting pushed. If you trade NASDAQ, it moves quicker, so you're going to make more money, which is literally the most unfactual statement that you can ever understand. Same thing with gold. Gold moves more pips or points, however you want to see it. It doesn't mean that you can make more money on gold just because it moves more. So that's also a narrative that you guys just need to understand. So the first thing we have is the exchange rate. So exchange rate is obviously if you have the US dollar versus South African rand. Okay. First pair is your base pair. Second pair is your quote pair. So base pair is always 1. 1 US dollar at the moment is 18.58 rand. So once again, if you look at the news, it's going to say 18.58. In Forex, they add decimal points, and that obviously leads to points in the market for more movement, and that's obviously why it's a $6.3 trillion market. Okay, so we obviously trade the market up and down. In Forex, you don't physically buy or sell something. So you don't physically buy the dollar or buy the rand. You speculate on where the price is going to go up or down. Due to the bigger institutions trading the market, it forms patterns in the market called supply, demand, support, resistance, etc. And that patterns is the reason why we can obviously trade the market, because that patterns is going to keep happening over and over due to the bigger institutions following the same routine that they've been doing for multiple years. Okay, so if we go to the second one, we're going to have pips and points. So although the market says rands or dollars or whatever it might be, the market actually moves in what's called pips and points. So first thing about me is I don't confuse anything. The Forex market is already confusing to just try and figure out what's going to happen today and tomorrow and next week. So everything I say is always going to be how to simplify everything in the market. So if you look at pips and points, okay, there's a lot of people that will have different opinion on pips versus points. For me, when I started learning how to trade, the only word was points. Okay. For example, if we suggest that USD is going to move up from this blue line due to a support and a triple bottom to that specific level. Okay. The first figure you will see is 370. Okay. That means 370 points. Okay, 370 points. Okay, the second figure you will see is going to be pips. So it's 370 points and 37 pips. Okay, so pips is points divided by 10. Okay, let me just quickly fix this. Pips. Okay, so pips is points divided by 10. But if you work out your risk management, you're going to be using points. So for me, why do you want to divide by 10 and then times by 10 again? So let's say, for example, we're looking at this position and we're looking for something in that sense. Okay, so we're saying that we are speculating. Obviously, this is not a trade, this is just an example. We are speculating that price should be moving up to that level. So if it goes to that specific level, our upside potential is 370 points. Our downside risk is 117, meaning 117 points. So meaning that for every 1% we're going to be risking, we're going to make 3%. So it's a probability game that will come in and obviously work out in the long run. So the reason pips and points is important is because it will tell you how much you're going to be risking or how much you're going to be making. So let's quickly go to the second part of this, which will be lot size. So in the market, you trade with what's called the lot size. So you don't say, I'm going to be trading, putting $5 into this trade. How it will work is if we have 370 points, okay, the smallest lot size that you can use on a broker is a 1 cent. So 0.01, okay. There's no biggest lot size. You can literally use a 10 cent or 20 cent or 1 lot size or 2 lot size, whatever it might be. So the key to this is if you're going to be risking 117 points, how to calculate your risk will be 117 times 0.01 lot size. So that means we're going to be risking $1.17 on this trade if we do use a 1 cent. If you look at the upside, I don't know why it didn't change. Okay, there we go. So if we look at the upside, if trade goes our way, we're going to be making 370 points, and that will equal to $3.70. Okay. Once again, for every $1 we risk, we're making $3 due to risk to reward. Forex for me is all about probability. Okay, everyone wants to get into a trade, and as soon as you go into profit, you close the trade. But that means you're risking 1% to make 0.4%. If you're trading like this, you might as well go to a casino because your odds are better. So you need to understand the concept of probabilities and risk to reward. Even if you can risk 1% to make 2%, it's a good probability because it means for every 1% you lose, you make 2% back. And that allows you only to be profitable 40% of the time and still make money. So that is where probability comes in. As a trader, you will take losses. So these guys that you see on Instagram, TikTok that never loses, it's not a factual way. I can tell you now, people lose money even after 10 years. I still lose trades on a daily basis. So you're always going to lose trades. But it's about making sure that you win more when you win and lose less when you lose. So if you have a 1-to-3 risk to reward ratio, meaning you're risking $1.17 and you're making $3.7, you only need to be correct 3 out of 10 times to actually make money. So it's a game of probability. Okay, everyone with me? Does it make sense? So it's really important to understand lot size because your lot size will determine that. So if, for example, you said you want to risk $5, that means that you're going to be using a 0.04 cent, and that will obviously equal to just under $5 risk. Okay, so that's how you calculate your risk. So a key factor that a lot of traders don't even know, even after 5 or 6 years, is every market has a different pip value. Okay, so what is a pip value? If you look at AUD, okay, if the market moves 100 points, okay, it actually moves 100 points because the pip value on AUD is 1 to 1, okay? But on a pair like Euro-AUD, which is a less traded pair by the bigger institutions, has a lower pip value. So the pip value, I've never traded this pair in a long time, so the pip value is 0.68, meaning if this market moves 100 points, okay, it's only moving 68 points due to a lower pip value. And why does that make a difference? Just quickly look on AUD. This whole move, 250 points. Euro-AUD, 409 points. So it seems crazy, and it seems like it moves quicker or all that narrative that's been created. But due to the pip value, it will actually come down to the same dollar value, if it makes sense. Does it make sense to everyone? So every market is different. So CHF, for example, has a higher pip value, meaning if it moves 100 points, it actually moves 116 points. JPY or JPY, lower pip value. AUD NZD, lower pip value. Or USD, 1 to 1. Euro-AUD, 7.19. Euro GBP has a higher pip value, meaning for every 100 points it moves, it actually only moves 130 points. So really important because if you use a 1 cent, for example, on Euro-AUD, automatically you're going to have a bigger stop loss due to the lower pip value. But if you obviously divide it by 100 and times it by 68, the dollar value will be exactly the same. So on a currency like Euro-AUD, you're already going to have a bigger stop loss because the spikes will be bigger than on a currency like USD. Okay. Then we have, secondly, so that's just the calculations. We will obviously be sharing this book with all of you guys as well. So just like any financial service, you need a middleman, you need a broker. So in the Forex market, you get yourself the trader, the middleman, the broker, and obviously the liquidity. So a lot of people, for example, will sign up through a partner, let's say through AA partners, providing trading signals or robots, whatever it might be. Then we call them from the broker and they actually think that we are providing the signals or whatever. We as a broker do not provide financial services in the sense of signals or what do you call it, robots or whatever it might be. We are just a middleman connecting you to the market. So for every single trade that you need to take, you need a middleman that will connect you to the liquidity, which is obviously the broker. So a broker is a broker, doesn't matter where you go. The key differentiation between brokers is the service that you get, the products offering, the spread, etc. Okay. Then this is just a list of the most traded currencies. For me, if you're a new trader, I'll always try and focus on the most traded currencies. And the reason for that is they are obviously more stable. Why are they more stable? Because if they are traded by big institutions, they obviously automatically become more stable due to the patterns being created within that specific market. Okay. So then there's another list of all the currencies. So this is all the currencies that is tradable. And the reason I share this with you is when I started trading back in the day, for me, it was quite simple. I need to educate myself. I need to learn the ins and outs of the market. Because the question that I've gotten the most probably throughout time is, what's the easiest pair to trade? What's the best pair to trade? There's no easiest, there's no best. Okay, for me, I love AUD. I understand AUD. I've been trading AUD. I think my first ever Forex trade was on AUD. My biggest loss also been on AUD, which is my first account that I've blown. If you go back on my social media to, when was it, 2015, 2016, my first ever account that I blew was on AUD, and I'll obviously explain why in a different environment. But there's no best or better currency. If we look at this specific market, okay, the key thing we can identify is, even if you have never traded before, you can identify this market is running within a range, okay? You can identify this market is running within a range. Then it breaks through, goes back into a range. So already what we can expect with AUD is after it breaks out of this range, we're going to see a big move to the downside or to the top side. So that's not me being smarter than anyone or knowing more than anyone. That's just based on the facts that we can see from the market. It ranges, runs to a different side, ranges, runs to a different side. So that is obviously the key indication that AUD is a ranging market. If you look at CHF-JPY, you can see it's a different situation. CHF-JPY is a trending market. So if you, for example, prefer trading pullbacks with FIB, trend lines, whatever it might be, then obviously this will be more a market to your liking than AUD. If you prefer trading ranges, then obviously AUD will be more of that specific pair. So what I did is every Sunday, I'll actually analyze the market. I always started on the higher time frames, which I will show you guys tomorrow night. And I'll break down exactly what I'm expecting for the week ahead. TradingView has a tool where you can actually put in your prediction, put in your stop short, take profit, and you can hit publish. Okay, then you can type in AUD, why you buying that specific market, and then you can actually put it in. And the reason this was important, this was like an online journal for me. Then I'll actually come back the next Sunday. I'll see how all my predictions played out for the week. If I keep losing on AUD, I'm going to remove AUD from my list because obviously I don't understand something that's happening within that specific market. So if you guys look at Forex Other, this is all the pairs that I've already moved out. And simple reason, I don't understand them. I don't know how they move. I don't understand how they operate. Or I've lost money on them and I've just never been profitable with them. So it's always about eliminating what you're not good at and keeping what you're good at. And it can be gold. Maybe you're good at trading gold. I don't know. Maybe you're good at trading indices. I've never found success on indices. It doesn't mean that I'm a bad trader. It just means that I don't understand the specific structure. For me, it moves way too much. There's a lot of things happening. There's not a clear structure. So already I can tell myself that this is going to be more of a smaller time frame day trading pair than compared to AUD. And then let me just get some water. No, Trive does not offer the no deposit bonus. Very specific reason why. I mean, this call is recorded, so you guys can also go back on it. A no deposit bonus is basically just to get clients in. If you look at guys providing a no deposit bonus, if you actually look at the requirements for you to withdraw money from that account, you'll never be able to do it. It's yeah, you'll never actually make a withdrawal on a no deposit bonus. Remember, it's no one will give you. let's just use an example so I don't feel like I'm pushing someone out. Let's say I give you a $10 no deposit bonus, and let's say Trive has 100,000 clients. Yeah, and you understand where this is going. No one's going to fund 10,000 traders or 100,000 traders with $10. So brokers offer a no deposit bonus to get you to start trading with them. You most probably will lose the no deposit bonus due to spreads and all these things, and then eventually, you'll end up trading with them due to the fact that they gave you free money, which actually never happened. The spreads, you can check it out yourself. There's multiple accounts. There's the ECN account with lower spreads. There's a standard account with a little bit higher spreads with over 100% bonus. So multiple accounts that you can obviously look at. Then choosing currencies is actually what I just explained. I actually just jumped myself ahead. So this is how you choose currencies: by number one, predicting; number two, by physically trading. Like I said, just with like anything in life, you need to do trial and error. You're going to lose money. You're going to learn lessons. At the end of the day, it doesn't matter what you do. If you get, let's say you're unemployed, you're getting out of university, and tomorrow you get a job opportunity. Some people have this perspective that you're going to get a new job or your first job tomorrow and your boss is going to pay you up front for you to work there for the month. No, you're going to work there for 30 days and then you're going to get paid at the end of the month. So why does it have to be different when you start trading Forex? So you first want to get paid and then learn the lessons. Doesn't 100% make sense. And that's why I keep saying, if you start understanding the business side of trading and understand Forex is a business, then you'll also have a lot sooner breakthrough than you would if you go into the mindset of you're going to make money first and then learn lessons. So really important to understand that narrative. Trading is a business. You're going to learn lessons, but eventually there is an opportunity to make money out of it. And just to explain this simple narrative, when I started trading 10 years back, the success rate of Forex trading retail was 4.2%. Okay. The success rate currently, based on the data that we had from brokers, is 28%, meaning a 24% increase in trader success. So it comes back to the same narrative. People will say, yeah, I need 28 out of 100 people actually make money. But how many people in school of your friends wanted to be professional rugby players? Everyone. If you literally into sports, everyone thought they're going to play rugby for a living. And if you look at your friends now, who's playing rugby for a living? 0%. So if you look at who wanted to become an engineer and who actually became an engineer, it's like probably 2% or 1% of people. So once again, just do the financial markets having a transparency of who is successful and who not, it also pushes traders away, because for you, it's like, okay, well, I need to be part of the 28%. But if you don't want to be part of the 1% of the world, then trading is eventually even not for you as well, because you need to have the mindset of the 1%. That's the only way that you will succeed in anything in life. So what platforms do you use as a trader? So the first platform you use is TradingView. And once again, I don't own TradingView. I'm not an ambassador for TradingView. The only reason I use TradingView is it's a really easy to use platform. This is where I analyze. This is where I break down my charts. This is where I do my predictions. And if I, for example, see this is a good trade, then I will switch over to a platform called MetaTrader. And then I will execute the trade on MetaTrader, but I will keep monitoring the trade on TradingView. And the reason for that is on TradingView, you don't see red and green, or red and blue flickering the whole time. All you see is a chart, and you are making a prediction based on what the chart is telling you. So as a trader, if you go to MetaTrader, you enter a trade, you put your stop loss in. As soon as this market goes a little bit into red, you end up closing your trade. And the next day you come back and all you see is something like that. It's the same thing. If you bought there, you would go into negative first, and then you would take profit. So it's really important to trust yourself, stick to your predictions, and that way where it comes down once again to using the prediction tool, because if you take a trade, use your prediction tool. This is the only way for you to evaluate the mistakes that you're making. If this trade, for example, was a trade and it played out, then and you closed early or you didn't take the trade, then you can say, well, why didn't I take the trade? Why did I close early? Why did I close when I hit when market went against me? If the market went against me and then went up, why did I not maybe add another buy in there to increase my risk reward? So it's always about evaluating what you did or what you didn't do to find out what your mistakes is. It's always about adjusting around your mistakes that you make to achieve profitability. Then we have leverage. Sorry, guys, you've been talking a lot. So leverage is obviously something that traders use to trade bigger than they're supposed to trade. Okay. If you open an account with a broker, you'll usually see it starts with 1 to 100 leverage. Okay. And then you'll obviously see 1 to 1,000 leverage. You'll see 100% bonus. 100% bonus equals to 1 to 1,000 leverage. If you see 200% bonus, that will equal to 1 to 2,000 leverage. So bonus is just a leverage hack. What it means is if I have 1 to 100 leverage, okay, it means I can trade with 100% of my account. Meaning if I have a $100 account, the max lot size I can use is a 10 cent. And if I do use a 10 cent, I basically have 1,000 points of negative or drawdown to work with. If I have a 1 to 500 account, it means I can trade 5 times my account, meaning on a $100 account, I can enter 50 cent, but also my max exposure is going to be 200 points. So for me, just a suggestion, always start with the lowest possible leverage that you can. Okay. Once you're consistent and once you start making money, you will understand how to use leverage to your advantage. Leverage is not a product for you to make more money. Leverage is a product for you to leverage the market once you have the skill set to do so. So I always start with the lowest possible leverage, and then from there, I'll start building it up. And once I do understand how to use leverage. Okay. Then spreads, just like any broker, whether it be insurance, banking, whatever, there's a spread fee. That's how a broker makes money. So you'll see a blue line, you'll see a red line. The difference between that is the spread. So the blue line is the actual market price, the red line is the broker price. Once again, spreads is always going to be there. If people are still in 2025 complaining about the fact that there's spreads, I really do not get it, because spread is always going to be there. If I'm going to take a trade on AUD, for example, and I want to place my stop loss there on 135 points, if I know the spread on AUD, for example, is 10 points, automatically I'm going to move my spreads off my stop loss to 145, because the spread is always going to be there. It's not something that's going to disappear tomorrow. It's the same thing with, if you guys understand insurance, so I'm also in the insurance industry in some ways. Insurance brokers, I can't tell you exactly the amount, but let's just say insurance brokers makes a lot of money from their clients. Okay. So for example, they have a medical aid of 1,000 rand. That insurance provider will most probably sell you that same medical aid for 2,000 rand. But you cannot physically go to the direct guy creating the product and buy it from them. You'll always go through Discovery or Investec or whatever it might be to get the product. So there's also the spread. We all know it. We're all going to pay it. It doesn't matter how it works. So the same thing with the broker. There's always going to be spread. If I do a EFT now to Kagiso, I know there's going to be a banking charge. It's not like I'm going to wake up tomorrow and call my bank and ask, why did you charge me 6 rand for the transaction? It's going to be there tomorrow, next year, next week. So with spreads, stop complaining about spreads. Obviously, if the spread is ridiculous, I do understand it. But spread is always going to be there. So either you learn to live with it or you're not going to be able to trade. Okay. Minimum deposits. Kagiso send the spread so you can check it out. There's no minimum deposit at Trive. So buying and selling. Obviously, like I said, we don't physically buy or sell, although it says buy or sell. It will say buy is betting on price or speculating on price to go to the top side. Sell is speculating on price to go to the downside. So if you buy at that red line, same example as on USD, That means everything from the point you press buy to the top side is profits. Anything to the downside is obviously losses. So the reason, once again, why we're able to trade Forex is due to patterns being created. So if we, for example, look at this key level over there, okay, key area of resistance there at the top. So if we sold on that level and, for example, we put our stop loss above that level. So how to put your stop loss in your take profit, that's obviously something we'll do in a different lesson, but that's more or less what we are working with. That means we sold there, price went our way, we made money. We sold there, price went against us first, and then we eventually made money. Sold there, price went our way, we made money. Price sold there, went our way, made money. If we, for example, bought there, we went straight into negative, eventually made money. Straight into profits, and then obviously this I can't, not financial advice, but I don't believe this is going to go up. I do believe it's going to continue to the downside. But if we had to buy here and price goes down, why do we place our stop loss there? Because that is where the bottom of the liquidity is at. If price closes below that point, it is not going to stop until we reach that point. And it comes down to a basic logical thinking of what I already explained to you guys in the beginning. If price is in a ranging market and we close above, it's going to keep going up. So if we are in a ranging market and price closes below, it's going to keep going down. So if price closes below that level, you want to hit stop loss. Okay, take your 1% loss and look for the next trade. Once again, probabilities. If we lose this trade, we lose 1%, but we already made 3% on that sell over there. Made 3%, lost 1%, still up 2%. Risk, reward, and probabilities. Okay. Then next thing is, so long and short, just two different words people use as well. Why? Can never tell you. People will say, I'm shorting this market. Why did I say short when the platform says sell and buy? 10 years, I've never figured it out. So, like I said, keep it simple. MetaTrader says sell and buy. TradingView says sell and buy. So just stick to sell and buy. I think a lot of words are created to just sound better than other people. So in the market, you get what's called market execution. That's where you're physically going to see this is a good trade. Press the sell button or press the buy button. That's market execution. You also get what's called a buy stop or buy limit. So I always enter manually. I've never entered a trade first with a sell or buy limit. And the reason for that is we are trading in a reaction market. Okay. It doesn't mean because this is a support level that price is going to be reacting to this level. At the moment, price is not reacting to this level, meaning that it might have been a possible buy position, but due to how price is looking at this current state, it's not reacting to that level. So already I'm not going to be looking for a buy, I'll look for a continuation to the downside. So if you look at, for example, price jumping in there, price moved into that level, reacted immediately, formed the candlestick patterns called spinning tops, took out the traders selling early, closed below, reacted, sold to the downside. So that will be a manual trade that I took based on the reaction of the market. So it's always trading for me. One of the key things is reacting to what market is giving you. Okay. Then a buy limit will be, for example, saying that as soon as price reaches this level, it should automatically buy for you. So it is something you can use, but to your advantage. But yeah, once again, we'll use that for a different session because it's quite a longer explanation to say the least. Okay. Then this is just me explaining how to use buy and sell limits, how to put it in. Like I said, you guys can also go through it. So just a quick explanation of how I use buy and sell limits. Okay. There we have a clear buying area. Okay, we can all agree, we can all see price buys from there, price buys from there, price buys from there, price buys from there. Okay, how I will use it is I will obviously execute a manual trade due to the reaction from the market. Okay, then I know that I'm putting my stop loss there because if price closes below that specific level, I want to be out of the trade. So most times when you take a sell position or a buy position, price goes against you and then goes your way. So what I will do is I will have a sell limit in my stop loss area. So if price goes against me, I'm already backing that stop loss level. If price doesn't close above that level, I'm still fine to be in this trade. So if price does go against me, I'll obviously have sell limits placed within that region to increase my risk to reward. Okay. A little bit of a longer conversation we'll still have in different sessions. But yeah, I mean, Dion can tell you guys, Dion has been doing that maybe too much at times. But yeah, it does work if you understand how to use it. As a beginner trader, focus on one position, one stop loss, one take profit. But in time, you will once again, just like leverage, understand how to use buy limits and sell limits to your advantage as well. So this is just a simple example. They went against me, had a buy limit in, went from 1 to 3, 1 to 4 risk to reward, pushed my trade to 1 to 10 risk to reward, meaning that for every 1% I risked on that position at the bottom, I made 10%. So 13% trade, risk 2% in total, meaning that I physically need to lose the next 14 trades for me to actually go into losses. Okay. Same thing with that bottom trade, due to it being close to the stop loss, increases your risk to reward to 1 to 23, meaning you're risking 1% to make 23%. If you get a trade like that, it means you need to lose 24 times in a row to actually lose money. Please help me how to calculate the risk to reward on TradingView. Yeah, in the next lesson, we're going to be doing risk to reward in depth to explain it, because it's quite a key concept to trading. We're almost done, guys. Yeah, I will record the lesson. It's already recorded. So different types of trading. Number one, discretionary trading. That is when you get to a point where I'm mostly at. So if you guys look at my analysis, it's usually one line or simple analysis. For example, if I look at CHF-JPY, CHF-JPY is in a selling trend. So I already know that I'm looking for short position on GBP-JPY. Why? Well, a lot of people ask, but that's once again where discretion comes in. Due to me understanding certain natures of the market, I already know what I'm looking for more or less. Same when I look at dollar index is bullish. We broke structure to the top side, meaning bullish dollar will indicate that I'm not buying at that specific level. So it's more a logical approach to the market. Then you get technical trading. So technical trading is basically using technical components to analyze the markets based on certain pattern behaviors. So for example, you'll get hedge funds selling from what's called the resistance. You'll get hedge funds that sells from a trend line. You'll get hedge funds that uses fibs. So there's multiple technical tools. Just like everything in the market, there's no best or better technical tool. If we look at, for example, let's say this sell position over there. That sell was based on resistance. That sell was based on a key supply area. That sell was based on not a psychological level. That sell was based on a market pattern. That sell was based on a sideways market or consolidation market. So there's multiple ways to interpret a sell. That's how it's based on spinning tops and a bearish engulfing candles. So there's so many different ways to interpret the market. But you can also say, okay, this was based on resistance and that's why I sold. You don't need 6 to 7 different things to tell you to do it. And that once again is why they say trading is 90% psychology, because imagine if you, just for you to wake up in the mornings to go to your job, you need 7 people to tell you you need to wake up now. It might be a problem. So you need to tell yourself to wake up. And the same thing with trading as well. You don't need 100 things to tell you that it's a sell. It's based on a logical thinking that you're going to take to the market, and you can make decisions based on 1 or 2 components that will give you the confirmation for you to take the trade. And the key thing that I always say is whether there is analysis in or not, the market is still going to move up or down. So the analysis is not you adding a trend line or a support level on this market will not all of a sudden push the market up. So that's also something that's really important to understand. Okay. Then fundamental trading, which is one of the most enjoyable experiences when it gets to South Africa trading. is trading news events. So we see it all over the place. Why do people trade news and why is such a big thing? I can't tell you. Yeah, it's literally can't tell you. So every now and then we have news releases, and then based on the data, the market will obviously have a big move in the market. But remember, doesn't matter what broker you use. If a news event comes out and you're in a buy, you're going to make money. If you're in a sell, even if you have a stop loss there, it will not trigger, and I'm going to repeat that. News event will not trigger a stop loss. Doesn't matter if you are trading straight with the bank. The reason for that is pretty simple. You have a sell over there, okay? The banks are also in sells, buys, whatever it might be. So once the market moves up within 1 second, all the banks that is in sell positions or institutions will get liquidated. So if you have $100 billion getting liquidated, that causes a gap within the market, and that's why you guys will see gaps in the market. You'll see it more specifically on indices. It is orders that is getting liquidated, and the market moves too quick for price to capture that specific movement. So it is a really difficult to trade news events. I will teach you guys how to understand and read the news, but now you're waiting. This is a simple support level. Everyone can see price buys from there, price buys from there, price buys from there. Okay. If we had to go deeper into it, should be a psychological level of 68500, should be a triple bottom market pattern, multiple things telling us to buy. Okay. But now you're just waiting for that news event. Okay. Or you can just say it's a buy based on what the market is telling me. So rather than you just going full margin on one news event, you could just buy and run it like a normal trade. Or you can wait for the news event to stop, and then you can obviously trade based on the breakout. Price broke structure to the top side, came back to, which is most probably a 61 to 78% FIB, psychological level of 68750, etc., etc. And then you could have caught a better move based on an actual logical fact of the market. So there's always multiple ways to interpret it. Like I said, if I've seen news trading turn out quite badly for a lot of people, news trading once again comes down to risk to reward. Understanding that you're not going to win every news event, but if you risk 1% yeah to make 3% on that news event, that means you need to lose 4 news events for you to actually lose money. But what people do is they put 100 Rand in, they make 300 in the next news event, they put in 300 and they blow their account, and then they just hate Forex. Okay. And I will always thank you for that gold time to chicken teachers last year. Oh yeah, perfect. So what he's talking about for everyone, there's a YouTube video where I explain how I trade gold every single day between, that's why you see the blue lines. So I only trade gold between 12 and 4. So that was the position on Monday. Worked out, but didn't have a big move. That was the position yesterday, and today I was out of office, so I didn't trade gold. So I trade gold between 12 and 4. A lot of people will ask why 12 to 4. I don't know. It's not, once again, that the guy at FNB called me and said to me, trade gold between 12 and 4. It's a thing of me loving what I do and putting a lot of effort into it, and me seeing that price usually moves between 12 to 4. So how can I execute on that? It's not something that I read in a book. It's not something that I got from a course. It's once again me putting in the work based on the information that I've had and gained over the past 10 years. So for you, you can't buy a strategy. If someone sells you a strategy, once again, run away. You can't buy a strategy. You can buy components that will help you understand the market better. And then you need to take that components and go and make it your own and put it into your own perspective. Okay. Then almost done. Just get some water. I think we have like 2 slides left. Okay, types of charts. So you have a line chart. I've never used a line chart in my life. Then you also have a candlestick chart. So the market moves in candlesticks. Very simple. Green means up, also bullish candle. Red means down. You guys will see. Someone changed my chart layout. I'm only seeing now. Color of the candlestick really doesn't matter. I usually trade with black and blue candlesticks. I don't know who actually changed it, most probably Neo. But what will happen is the candlestick is all dependent on the bodies and the tails. That's all you need to understand. How does the body look? How does the tail look? Because the bodies and the tails will tell you whether there's buyers or sellers within that specific market. So how a candlestick works in general, it will open there. If it starts pushing down, it will be red, goes past the open price, becomes green, goes to the highs, eventually closing there. Where this candle closes is where that candle will open, and vice versa. Okay. Candlesticks on different time frames. If you are on a weekly chart, that means one candle represents 1 week. The higher the time frame, the more and higher the probability of a certain setup, candlestick, etc. So obviously, logically, a weekly candlestick close will be more important than a daily. This is how my candlesticks actually look. So for a lot of people it will look confusing, but that's a candle going up. A big weekly candle taking out 1, 2, 3, 4, 5, 6, 7, 8 days worth of data. What most probably happened the week after that? It kept going up. Okay, so that same data on a daily, we can also see just a little bit more candlesticks. That's obviously 7 candlesticks now, and then on the 4H, etc. So that's why I keep saying it's so important to start breaking your, even if you are a smaller time frame trader, start by breaking down your market on the higher time frames and then eventually moving to the lower time frames, because now you already know, am I looking for a sell there? No. Why? Because of the weekly candle and because of the daily structure, etc. So already you're creating the logical thinking of what you're looking for based on the hard time frame analysis. Okay. Then this is actually the final slide. There's the news. Yeah, after this we're done. So news you get on a website called investing.com. Also, no affiliation to them. It's just a website that we all use. We've all been using it. So that's where you will get all the news releases for the week ahead. So same thing, I'm not going to teach you guys how to understand or read the data now, because it's more complex than just understanding it. As a new trader, try and stay away from the news in the beginning. Just try and master the market and the charts before. Later on, you will understand how to use the economic data to your advantage. For example, if you guys have watched my videos on NFP, I mean, we've been quite accurate in the sense of my personal opinion, if I have to put it that way. So what I will do, for example, is say, just more or less, the previous was 165. Okay, prices of the data has never been to 165, meaning the low of the probability is 165. The high is 517. So price is obviously forecasted to come back at 180K. So the probability of price coming back below 180K is 0. It's never been there. So the probability of price coming back at below that is almost 0, because it's never been to 180K. So that means the probability is higher for price to come back higher than the forecast. And that's exactly why we have higher data. So it's a probability game once again with the data, and there's obviously more to it, but the probability of what is price going to do with that. And if we, for example, know that we're expecting green data, fundamentals moves with technicals. That's really important to understand. If we look at USD, okay, USD, if you're a new trader or been trading for 10 years, we can all agree this is in a clear selling trend. You're not looking for buys. Never in your life say something is oversold or overbought or all that stuff that people nowadays say. This is not overbought or oversold. Go to the higher time frames and you'll see price has been lower, price has been higher. So once again, words created by people that want to turn around the market. Never try and turn around the market. So if you have a news event coming out, let's say in 1 minute, okay, and the data is indicating that price should keep going down, that is where you have that one candlestick that's going to point straight down. Okay, if we have news that is forecast to go against the trend, that is where you're going to see price pushing into a key selling level and retrace straight to the downside. So when you see the spikes, exactly, buying trend, price spikes into a key buying level because it's going against the trend, pulls back, continues to the top side. Where the news goes with the trend, goes straight up. Okay, so technical fundamentals moves with technicals. And I think that's it. I think there's just one last slide that I always add in about patience. Yeah. Remember, guys, the Forex industry has also gotten to a point where, yeah, it's on TikTok, it's on Instagram, which is a 20, 30-second clip, which obviously gets to a point where we slow down our attention span. And that obviously has some issues to the market itself as well. No issues with obviously promoting on TikTok or whatever. I'm just saying, due to the nature of the world we're living in with TikTok and Instagram, it slows down our attention span. I mean, back in the day when I was a kid, I can watch 6 hours of movies. Now I literally watch 5 minutes and then I'm on my phone or I'm standing up or I'm getting water, coffee, whatever, because our attention spans are so small. So Forex market remains the biggest market in the world at $6.3 trillion. So for you, you need to understand it's going to take you time to learn. I've been trading for 10 years and I can tell you guys it will take time. It doesn't mean that you will take 10 years to be a consistent or profitable trader. It just means that it will take you some time. I always talk the honest truth about Forex and Forex trading specifically. I can also tell you safely, I have a lot of best friends that trade full time, don't do anything but trading. They don't have any other income. They physically wake up, they trade, and that's all they do. So it is something that's achievable, but also something that's achievable with the realistic aspect of the market. So meaning with that is, if you, for example, know that you're making 20,000 Rand a month in salary, why do you want to all of a sudden start something that you've never even touched before and make 100,000 Rand? Like, does it make sense in your brain? If you're going to start a new business tomorrow, you're going to need some cash to put into the business. You're going to have to pay your staff, your service providers, etc. So you're most probably going to lose money for the first few months, and then eventually you will get to break even. Then eventually you'll start making money. Forex is the exact same thing. Never try and make money from Forex. Try and once again build something that's sustainable. If you make 20K a month, figure out, how do I get to 20,000 Rand a month with Forex? From there, you will figure out how to scale it, but it should always be a realistic goal beforehand, because people are finding $50 and trying to make $500 on a daily basis, which is not sustainable. Focus on becoming a consistent trader. Through becoming a consistent trader, you'll figure out how to scale it. Through scaling it, you'll start making money. Through making money, you'll free up some time. Freeing up some time will help you to push and figure out new ways to obviously expand your trading, get more funding, etc., etc. So keep it realistic. Take your time. Don't rush into it. If you want to trade a demo for 6 months, trade a demo for 6 months. But once again, it's the only market where we can physically see what's happening on a daily basis. And we have a trial period. We can do predictions. We can trade on demo accounts. We can take our time. The market's not going anywhere. So be realistic, understand the long term, and yeah, you'll be all good.